Most buyers don't get denied because they're broke. They get denied because they missed this one simple rule nobody explains until it's too late. In the next few minutes, I will show you the 5-step approval checklist so you know exactly where you stand before you write an offer. And here's why this matters. I see buyers every week write offers, tour homes, and then get stopped cold by underwriting. Not because they lied, not because they're irresponsible, but because nobody walked them through how conventional loans actually work. Let's fix this. Quick question before we jump in. Comment approve if you think you're close, or fix if something needs work. I read these and it helps me tailor future videos. Step 1 is income and employment stability. And this is where people overthink it. In general, I want to see 2 years of stable employment. This does not mean that you can't change jobs, but underwriting does like if you have the same line of work or if you're going to have a 2-year working history. Now, electrician to electrician, for example, that will work. Sales to sales, that will work. Where it starts to get a little tricky and underwriting starts to slow down is when you go from W-2 to self-employment, or you have a decrease in the income that you have from whatever job that you transfer to. Those things will slow underwriting down and it will potentially not get you approved. Inconsistency matters more than income size. You can make $60,000 or $600,000. It's whether it's documentable and steady. Step 2 is credit. This is where buyers get technically eligible but financially punished. You'll hear conventional loans have a 620 minimum credit score, and technically that's true. But here's the real world part no one tells you. Many lenders add something called overlays. Even though the guidelines say 620 minimum credit score, the lender may require you to have a 640, 660 credit score, maybe even higher. Even if you get approved at the minimum credit score, 620, your private mortgage insurance and your interest rate are going to be brutal. Here's the truth. Approval is one thing, but payment is another. Better credit doesn't just help you get approved. It helps with your interest rate, which could lower your payment, also can help with the amount you qualify for. If you're barely sitting above the credit score allowed, improving your credit first could be the smartest move you make. Step 3 is down payment and assets, and this is where the biggest myth lives. You don't need 20% down for a conventional loan. On a primary residence, some conventional programs will allow as little as 3% down. Also put down 5%, 10%, 20%. There's a minimum, but here's the honest part. If you put the minimum down, conventional isn't always the cheapest monthly payment, especially if your credit is middle of the road. Sometimes Federal Housing Association or FHA has a better payment option. You deserve to see a side-by-side comparison and not have your lender push you to their favorite loan program. You deserve to see the math. Number 4 is the most misunderstood numbers of mortgages, which is the debt to income ratio. Known as DTI, it's the gross monthly debt divided by the gross monthly income before taxes. That includes your new mortgage, including car loans, student loans, credit cards, any lines of credit or credit on your credit report. It does not show groceries, gas, power bill. That's your budget, not underwritings. In most conventional scenarios, around 45% DTI or debt to income ratio feels normal. Stronger files can push higher, but there is a ceiling. Here's the key takeaway. Just because you can qualify for a higher debt to income ratio doesn't always mean you should. House broke is real, and lenders are not the ones living with that payment. You are. Step 5, loan size and loan limits. This matters more than people realize. Conventional loans have maximum loan limits. Go above them and you're in a different set of rules and regulation. Conventional loans have maximum loan limits. You go above them and you're in jumbo territory with different rules. Now let's talk about one of the things you've probably seen online where there's certain programs that do not need a credit for conventional loans. Yes, in late 2025, there were changes to how certain conventional loans were assessed. But that does not mean no credit, no problem. Underwriting still evaluates risk. Strong borrowers still win. stable income, reasonable debt to income ratio, strong assets, and a clean payment history still win. If you're thinking about buying in 2026, the worst move you could make is fall in love with a home and then find out you have a problem. Start early, get real numbers, fix what's fixing while time is on your side. If this helped, hit the like button, subscribe, and comment checklist if you want me to break down exactly what documents lenders look at next. And tell me this, what's the hardest part right now? Down payment, monthly payment? Let me know. We'll see you at the next one.